G'day, Nick Hubble. How you doing?
Yeah, good to be back, Woody. Just a quick update on the bank next door. It has been completely demolished. It's just
Oh,
an empty
right.
lot
Have they
now.
not put a new one up yet?
No, they will eventually, but I will be back in Australia by the time they start construction. The whole house was shaking as the demolition happened, so it's actually quite scary.
Yeah. And if readers don't remember what we're referring to, just go back a few videos and rewatch it. But today, Nick, you've been all over the place. You've been to Spain, Barcelona. You had a few stops in London where you spoke to a few gold guys and fund managers and things like that. One of the people you spoke to was Dan Denning. Now, people might remember Dan Denning here. He's actually the founder of Fat 10 Investment Research. But his big thesis, and I listened to that discussion, and we'll make that available for our readers very soon. But you're talking about mean reversion, and that's really the focus of today's Fat Tail Daily piece. Now, you draw a pretty fascinating parallel between today's US market concentration and Japan's dominance in the late 1980s. What are the similarities? What are the similarities you see, or why did you make that connection?
Yeah, it's all about the US stock market outperforming to the point where it's getting a bit ridiculous. And that's what is so similar about the US relative to Japan in the 80s. This idea of things getting just a bit out of hand, about the boom just getting a little bit too big. And as that happens over time, statistics start to pop up that just don't quite make sense, don't pass the pub test. So, for example, the US stock market is now worth about 72 or 74% of the global stock market in total market cap. I think that Japan peaked at about 50% in the 80s at some point. And that was considered an extreme. Now, obviously, the US market should be the biggest one relative to the others for all sorts of reasons. So Japan's worth about 6% of the market cap now, which is obviously a radical shift, right? Back down to something closer to normality. Well, the US market's outperformance has made the US the extreme and absurd one now. And the implicit conclusion you might want to reach from this is that it's going to correct, that there's mean reversion, that there's going to be some sort of return to normality over time. And there's two different ways that can happen. Well, actually three. One's that the US stock market goes down. One is that all the others go up faster than the American one. And the third one, which I only just recently learned about as a potential idea here, is that the profits that American companies make actually catch up to justify the extraordinary overvaluation, extraordinary outperformance of American stocks relative to the rest of the world. And given what's going on in Europe overnight with the French market melting down, French government melting down, and this terrible economic performance in Europe, there's a good chance that actually might be the way this goes.
Right. So that's what I was going to ask. My next question was going to be beyond valuation metrics, what specific market conditions or catalysts you think can trigger a mean reversion? So you think it's the latter one?
Well, I think that's still less likely, but it's a sort of surprising possibility here, right? That America, as an economy, as a financial market, as a corporate system, actually justifies the valuation that it's being given by financial markets. Say Trump succeeds while the rest of the world goes absolutely insane on its debt crisis, on inflation, or whatever it might be. Say corporate America really does capture, because it's got cheap energy prices, the global industry. Say Trump's trade war goes unusually well or unexpectedly well. Perhaps these valuations are justified. Perhaps there's a geopolitical meltdown in Europe with Russia. Perhaps investors are correct in how they're valuing the US. But I think by far the more likely solution remains that the US market underperforms quite badly for the next, say, decade, because these are very long-term trends. The US market's been outperforming for about 10 years now. Long-term wise, the US market could outperform, and the better place for investors to be will be places like Europe and Australia and the UK, perhaps Canada.
Yeah, I was gonna again. You're doing a Jim Rickards, Nick, and you keep preempting my next question, which is not a bad thing. But so it was going to be like so obviously our audience is heavily based in Australia mainly, although we do have readers outside. But for investors looking to position themselves or prepare their portfolio for a potential mean reversion, however long term, what markets or sectors outside of the US do you see offering the most compelling valuations relative to fundamentals at the moment?
There's only one particular sector of the US market that's actually driving almost all of this, and that's the tech sector, the Mag 7, or however you want to classify it. So just I think the 10 biggest companies in the S&P 500 are the ones that are totally blowing out on valuations. And they're so big and so important that the rest of the market is sort of getting dragged up with them. So you can still go bargain hunting in a lot of the US market. But the idea here is to look outside the US really, and to go to places like Australia's commodity sector, certain European industrials, perhaps companies that are beaten down because their sector has performed badly, things like car companies and that sort of thing. So you want to look at anything that's beaten down badly enough, but is unlikely to fail in coming years, so that when the worm does turn, you're going to be capturing the improvement. And more importantly, you're going to be avoiding the things that don't perform well in the future. So it's a very simple value investing, effectively. You sell what's already gone up and you buy what's gone down, but won't crash.
But I guess the key question is when, right? And like how for investors who might be overexposed to those names, is there like a practical approach that for rebalancing, but without missing out on potential continued upside? Is it just lightening up? I don't know.
Yeah, that's the big question here, because this outperformance has lasted for so long now, and it's been so extreme for such a long period of time that every time someone comes on and says this, they get proven wrong over time. There's an interesting quote from The Economist, which says, that it's just getting more and more absurd, more and more extreme, and it's getting very difficult to sort of not lose faith in what's going on outside of the US. But like I said, it's a 10-year question. The easiest way to time this is to wait for trends to be confirmed. So wait for US markets to go down, sacrifice the fact that you're going to be missing, you're going to be losing some of those returns at the peak. Wait for European markets to turn up so you have a confirmation that there is actually a trend in place, and agree to sacrifice the fact that you're not buying into exactly the bottom. So turn this into a trend following exercise, which means we still have time to wait. We still need to wait. The worry on that is that the US market has a real crash in the meantime, because if it's only 10 stocks that are driving this outperformance and those 10 stocks correct very quickly and very suddenly, it could be quite a severe correction, quite a severe crash. So it's a test of your nerve either way, regardless of how you go about this. And in the end, the question is, do you want to be owning the stocks that are overvalued and have already gone up, or do you want to be owning the ones that have the potential to rise a lot? And I prefer the latter.
Yeah. Final question. You said it's a big, longer term picture, probably 10 years. Does the new administration in the US change anything, at least in the near term?
Yeah, that's a pure opinion question. I don't think there's anything of any value that I can add there. Everyone have their own opinion about how Trump's going to perform and what he's going to be up to, whether the deep state, as he calls it, is going to ensnare him in some new way or not. Whether his team at the Doge, that Elon Musk and Vivek Ramaswamy, for example, whether they can actually achieve what they're setting out to do, whether deregulation actually functions. Personally, I'd say no, that's not going to work out. I don't see them being able to upset that apple cart sufficiently to actually turn the US into something more dynamic and successful. I think there's a better chance actually of that sort of change happening in Europe, and Europe sort of fixing some of its problems in terms of overregulation and too much government and government debt over time. There's also then the question of inflation, whether Trump will trigger an inflationary crisis again. So it could all go well, it could all go wrong. I don't think I'm going to convince anyone of why they might need to change their opinion on Trump either way. So we're not getting anywhere terribly fast there. But he is introducing new risks as well. So even the people who think he's on the right track need to realize that that doesn't necessarily mean the rest of the government's going to go with him.
There's always trade-offs, right? There's no solutions. You do one thing, something else affects it down the line.
Well, in politics, I think just less government is a solution. But
yeah. Well, you don't have to sell me on that one. Let's see what he does. Nick, thank you, mate. We'll leave it there. It'll be good to see you in Melbourne soon. Maybe we can make that happen in the new year. I think hay fever season will be over by that point. I don't know. You tell me. You're the one that gets the allergies.
It's always hay fever season in Melbourne.
Exactly. All right, Nick. Take care, mate. Thank you. And for those watching, check out Nick's article today. It's totally free and it's in the description below. Check it out. Thank you. Thanks for tuning in to FatTel Daily. If you're ready to take a new approach to building wealth, avoiding the same old mainstream ideas and investigating new market trends, then make sure to hit the subscribe button and turn on post notifications so you don't miss a single video. And as a thank you, we've got a free report just for you.
It is packed with actionable insights that show you how to capitalize on an alternative investment idea that you'll unlikely find anywhere else. You can download it right now by clicking on the link in the description below. So, if you're ready to discover strategies that the traditional market just doesn't offer, grab your free report. Until next time.